Hi, we're going to start today with the introduction to financial derivatives. People get all concerned when we talk derivatives, and it's really confusing to me because financial derivatives are not that difficult. People tend to make them more difficult, and I think part of it is a marketing problem. That we use the word derivatives, and people don't like the word derivatives because it has connotations from calculus. It is not that. When we use financial derivatives mean that the value of one asset is derived, or if you want to call it, depends on the value of another asset. So we could call them financial depends if you want to, and you laugh at it instead of financial derivatives. The underlying asset, the other asset, is called the underlying asset. It can be anything. It can be stock prices, can be gold prices, any commodity, interest rate futures, you name it. It can be absolutely anything. So underlying asset is something that we can find the value of looking out in the real world. The derivatives market depends on that other market price. There's a couple different types of contracts. Forwards, futures, and options, the three main ones that we want to talk about. A forward contract is an agreement between two parties for the delivery of some asset at some point in time. Essentially what's happening here is we are trading assets in the future. I am bringing you corn, and you are bringing me money. We agree upon a price, we agree upon a delivery date, we agree upon everything. Everything in this is customizable. We can make it July 4th if we want to, we can make it Christmas Day if we want to, we can make it at 6 a.m., please don't. We can make it at 9 p.m., we can make it at any point we want. We don't, everything is customizable. Because of that, I have to be really sure who I'm entering into the contract with. A and B better trust each other because these are zero-sum games. At the end, there's going to be a winner and a loser. If I could sell corn for twice the price on the open market that I agreed to sell it to you, wow, I'm really going to lose a lot of money if I sell it to you. So I'm tempted to walk away from it. So you really want to be sure you know the other party in this. The other type of contract that we want to deal with is a futures contract. A futures contract is very similar. We'll see the payoff diagrams in the next video. The payoff diagrams look identical, in fact, between forwards and futures. The difference here is that these are standardized. They are traded. They are traded. There's very active exchanges. They are traded millions and millions of contracts per day. They are traded with a clearinghouse. So I don't trade with you. I trade with the clearinghouse. And the clearinghouse trades with you. So here we have the same type thing, A and B, but now A trades with the clearinghouse and B trades with the clearinghouse. So it's just a little different. And the reason is now I don't need to know B. I don't need to worry about it. B may renege on me. I don't know. But they're not reneging on me, they're reneging on the clearinghouse. So what I have to worry about is the clearinghouse reneging. And that has never happened in the United States. The final type of the final type of derivative we want to talk today is a little broader. It's financial options. Options, there are two types. There are calls and there are puts. And what financial options do is they create an obligation for only the short side. Unlike the other side, both had an obligation. If you are long an option contract, you never need to do anything. You can, but you don't need to. The easiest way to think of this is looking at a call contract. A call contract gives the owner the right, but not the obligation, to buy an asset at an agreed upon price at an agreed upon time. So here we have, let's come over here a little, I hope you can see it. We have an example I made with a gallon of milk. Let's suppose milk is $2.99 a gallon in this is down at the grocery store. We call it, the grocery store in town is called Spot, maybe Spot Market or something. Spot price is $2.99. You have a coupon that says, I have the right to buy it at $1.99. So, if you had this coupon, would you use this coupon? And the answer is yes. You would buy the milk if the spot price is greater than the strike price. The price on the coupon is $1.99. On the other hand, if the spot price was on sale for $1.79 this week at the Spot store, you wouldn't exercise that. You would let the coupon, you just keep that coupon in your pocket and walk away. If you understand this, you go a very far way to understanding stock options or call options in general. Options are essentially a bet on things that are going up. If you are long, you are expecting or hoping that the price goes up in value. We'll talk a lot about calls in the coming classes, but for now, just think of this example, and it works really, really well, and lots of levels, which we'll deal more with. Notice if you are long this contract, if you have the coupon, you do not have an obligation. However, if you are short the contract, in other words, the grocery store, they have to sell it to you. So even though the price is $2.99, they've created an obligation to themselves to sell it at $1.99. So we have a little different here. Unlike futures contracts, where both sides had an obligation to buy or sell, and they had an obligation at the end, only the short position has an obligation in options. The final type of option we want to talk about is a put option. A put option gives the owner the right but not the obligation to sell an asset. So, easy example, let's suppose I have a stock option that gives me the right to sell at $20 a share. If the price falls to $10 a share, I still have the right to sell it at $20. So that gives me an obligation, or it gives me the right to sell. I don't need to. If the price goes up to 30, well, hey, I'm going to go sell it at 30. I'm not going to sell it at 20. So here we have, again, only the short position. In the short position, in this case, what do they have to do? They have to buy it at 20. If it's at 10, if it's at 0, they still have to pay 20. So it creates an obligation only to the person who is short the contract. Final thing here before we leave for today, put-call parity. Put-call parity is a relationship between the stock, the put price, and the call price. And what it is the put plus the stock, and again, you see down here, the put has the same strike price as the call. So the put plus the stock equals the call plus the present value of the strike price. This relationship allows us to save a lot of work because all we need to do is find the theoretical value of the call, which we do with the Black-Scholes pricing model or binary option pricing model or something. I use Black-Scholes the most, so we'll do that. This is simple present value. We know how to do that. This is observable. Boom, we have the value of the put. So very easy, very straightforward, and hopefully it won't cause us any trouble. So that's our quick introduction to financial derivatives. We'll spend a lot of time over the coming weeks doing this. I'll have several more videos, but here's just a quick introduction.